Everything looks fine. Markets are reaching all-time highs. Retail investors are opening brokerage accounts at record pace. Financial media is celebrating a new era of permanent growth. Every anchor on every major network is running the same story. The fundamentals are solid. This is exactly what it looked like in 2007. Michael Burry does not consume financial news the way most people do. He reads filings. He reads balance sheets. He studies the behavioral patterns that repeat every single time a speculative bubble forms and collapses. And what Burry's research documents bears an uncomfortable resemblance to every major speculative breakdown in modern financial history. Today, we examine what speculation actually is, how it constructs itself, why it always ends the same way, and what Michael Burry's analytical framework reveals about the dangerous cycle now unfolding in global markets. Michael Burry is not a television personality. He is not a product of Wall Street's institutional machine. He is a former medical doctor who taught himself the craft of investing by reading every financial document he could find. In 2005, Burry identified a systemic flaw embedded deep in the American mortgage market. A flaw that virtually every bank, regulator, and economist had either missed or deliberately ignored. He constructed a position betting against it. The reaction from Wall Street was uniform: dismissal. His own investors fought him. His prime broker restricted his trading activity. His partners questioned his judgment openly. In 2008, Burry's analysis was proven correct. Scion Capital generated returns of 489%, while the global financial system collapsed around it. This is the man whose framework for identifying speculative bubbles we are about to examine in full. To understand Burry's argument about speculation, we need to understand what speculation actually is and how it differs from genuine investment. Burry draws a clear distinction between the two. Investment, in Burry's framework, means paying a price for an asset that is supported by the actual earnings, cash flow, or tangible value that asset produces. The price you pay reflects what the asset is genuinely worth today. Speculation, by contrast, means paying a price not because of what an asset is worth today, but because you believe someone else will pay you more for it tomorrow. The expected profit does not come from the asset's fundamental productive capacity. It comes from the anticipated behavior of future buyers. Burry has argued consistently that when speculation dominates a market, the feedback loop becomes dangerously self-reinforcing. Rising prices attract more buyers. More buyers push prices higher. Higher prices generate media coverage. Media coverage attracts even more buyers. The asset's actual value becomes irrelevant. What matters is only the crowd's collective belief that prices will continue rising. Burry's central thesis on speculation is precise and historically grounded. He argues that every major speculative bubble in history has followed the same structural sequence. It begins with a genuine innovation or real opportunity. Something legitimate creates early excitement. Investors who identify that opportunity early generate strong returns. Those returns attract attention from others who did not do the original analysis. As capital flows in, valuations rise beyond what any honest reading of fundamentals can justify. But the momentum is already self-sustaining by this point. New participants enter not because they have evaluated the underlying economics, but because they have observed the rising price and want to capture future gains. According to Burry, this is the precise moment when a market transitions from investment to speculation. The mechanism of the bubble is now fully operational. And once that mechanism is operational, Burry argues, it can only be resolved in one direction. The first pattern Burry identifies in speculative bubbles is what analysts describe as narrative displacement, the moment when the crowd replaces fundamental analysis with a story. Burry has studied this pattern across the railroad mania of the 1800s, the radio stock speculation of the 1920s, the dot-com collapse of 2000, and the housing crisis of 2008. In every case, a compelling narrative emerged that appeared to justify prices no historical valuation method could support. In the 1990s, the dominant narrative was that the internet had permanently eliminated the concept of business cycles. Traditional valuation metrics, analysts argued publicly, no longer applied. Price-to-earnings ratios were declared irrelevant. Cash flow was dismissed as secondary to growth potential. Burry's analysis of that period reveals something critical. The narrative was not entirely wrong. The internet did transform the global economy, but the transformation was real, while the valuations were fiction. The underlying technology created genuine value. The prices being paid for it did not reflect that value. They reflected the crowd's belief that future buyers would keep arriving in greater numbers. When those buyers stopped arriving, the Nasdaq lost nearly 80% of its value in less than 3 years. The second pattern Burry documents is the democratization of access. Each speculative bubble in modern history has been preceded by a significant expansion in who could participate in the speculative activity. The housing bubble of 2008 was made possible not simply by low interest rates, but by the deliberate dismantling of lending standards that had previously kept speculative mortgage activity constrained. When a bank would lend to anyone regardless of income or credit history, the pool of potential buyers grew dramatically and artificially. Prices rose because demand rose because access rose. Burry read the mortgage prospectuses cover to cover. He saw loan terms that no serious lender in a rational market would have approved. He understood that this expansion of access had decoupled housing prices from any relationship to income levels, rental yields, or genuine demographic housing demand. According to Burry's research, when access to an asset class expands dramatically and rapidly through loosened standards or new financial instruments, the resulting price increases are structural rather than fundamental. They reflect the flood of new capital entering the system, not any improvement in the asset's actual underlying value. The third pattern Burry consistently identifies is leverage concentration, the degree to which the speculative activity is financed by borrowed money rather than genuine savings. Burry has argued extensively that leverage is the mechanism that transforms a painful speculative correction into a civilizational systemic crisis. Without leverage, when prices decline, investors lose money. That is unpleasant but manageable. With leverage, when prices decline, investors are forced to sell immediately to meet margin calls or service debt obligations. Forced selling accelerates price declines. Accelerating price declines trigger additional margin calls and more forced selling in a cascade that feeds on itself. In 2008, the leverage embedded in mortgage-backed securities and their derivative instruments was so extreme that a decline in average housing prices of less than 10% across the country was sufficient to trigger cascading failures across the entire global financial system simultaneously. Burry's analysis of current market conditions points to significant leverage concentrations building across multiple asset classes at the same time, a condition he has identified as among the most structurally dangerous features of the contemporary financial environment. The fourth pattern in Burry's framework is institutional normalization, the process by which speculative behavior becomes not only accepted, but actively encouraged by the very institutions that were originally designed to prevent it. Burry has documented deep skepticism regarding the Federal Reserve's role in generating the conditions that make speculation irresistible. His argument is precise. When the cost of borrowing is held near zero for an extended period of years, the rational incentive to seek yield through speculation rather than through productive long-term investment becomes overwhelming for every category of market participant. Capital that would otherwise remain in savings instruments or low-risk fixed income products flows instead into equities, real estate, and speculative alternative assets in search of any meaningful return. This flood of capital elevates asset prices across every category simultaneously. Elevated asset prices are then reported as evidence of a healthy and growing economy, reinforcing the monetary policies that generated them. According to Burry, this feedback loop between central bank policy and asset price inflation is not an accident or a policy error. It is a structural feature of the system that consistently benefits those who already own assets while eroding the relative position of those who do not. The fifth and final pattern Burry documents is the sudden and violent exit, what he has described as the moment when the theatre door becomes too narrow for the entire crowd attempting to leave simultaneously. Burry applied this precise insight to his now famous analysis of passive index funds, issuing a public warning as early as 2019 that the structural mismatch between the size of major index funds and the actual daily liquidity of their underlying holdings created a trap that most investors had not modeled. In any speculative bubble, the exit problem presents itself in the same form, regardless of the asset class. During the ascent phase, liquidity appears abundant because buyers consistently outnumber sellers. At the precise moment when sentiment reverses and sellers begin to outnumber buyers, liquidity disappears with a speed that always surprises the participants who did not model it in advance. The assets that appeared easiest to sell become impossible to liquidate at rational prices because every participant is attempting the same exit through the same narrow door at the same moment. Burry has emphasized that this dynamic requires no fraud, no deception, and no external shock to operate. 2. It requires only the mathematics of liquidity mismatch and the predictable psychology of a crowd realizing simultaneously that it has been speculating rather than investing. Applying Burry's framework to your own thinking does not require managing a hedge fund or possessing a graduate degree in finance. The first principle Burry embodies demands asking one honest question before committing capital to anything. Where is the profit actually coming from? If the answer, examined honestly, is that the expected profit depends on future buyers paying higher prices rather than on the asset's own productive capacity, then you are looking at speculation. Recognize it precisely and accurately as such before proceeding. The second principle Burry demonstrates consistently is to read past the narrative. Every bubble generates a narrative whose function is to make fundamental analysis seem unnecessary or outdated. The narrative will always sound compelling. Burry's disciplined response is to go directly to the primary source documents, the actual filings, the actual prospectus terms, the actual balance sheet numbers, and determine whether the narrative is supported by documented evidence. In most cases, Burry has found it is not. The third principle is to model the mechanics of exit before ever entering a position. Before buying, Burry constructs the scenario in which he needs to sell in a declining market with deteriorating liquidity. If that exit scenario is acceptable, the position is acceptable. If the exit scenario is catastrophic, the apparent upside is an illusion. Today, we examined Michael Burry's analytical framework for understanding how speculative bubbles form, accelerate, and collapse. We traced the 5 recurring patterns he has identified across every major speculative episode in modern financial history: narrative displacement, democratization of access, leverage concentration, institutional normalization, and the violent exit problem. Burry's record across 2 decades of documented analysis suggests that these patterns are not coincidences of circumstance or accidents of timing. They are the structural and predictable consequences of human psychology interacting with financial systems under conditions of excess liquidity and insufficient independent critical analysis. The question Burry's body of work leaves each serious investor with is not whether the next speculative bubble will eventually collapse. Every bubble in recorded history has collapsed. The question is whether you will be positioned inside the crowd that is surprised when it happens, or outside the crowd that understood what was happening while it was still unfolding. That positioning depends entirely on one thing: whether you are willing to read what the crowd is not reading and to see clearly what the crowd is not willing to see. Thank you for watching.